There's 5 common mistakes that most private and hard money lenders make. Over the last 16 years, we've been lending private capital, so we've seen a lot of things. If you don't know me, my name's Jason Balin from Hard Money Bankers, and my business partner Chris Haddon and I started Hard Money Bankers in 2007. And then most recently, in 2020, we started a mastermind group called the Hard Money Mastermind. We've got about 25 to 3,000 private lenders all over the country. More on that later. So here's the 5 common mistakes. Number 1, not asking the right questions or enough questions up front. In this business, you have to be a salesperson, but you also have to be an underwriter. You can't lose capital. If it's your own money, if it's private investors' capital, no matter what, you can't lose money. You gotta ask the right questions up front. So many lenders just wanna jump to the case and just assume that what comes out of the borrower's mouth or the broker's mouth is accurate, and they go with it, right? They get emotional about the transaction. They do whatever they got to do in order to get the deal to the table as quick as possible. And I know we want to close loans. You can make good money when you close loans, but you got to be an underwriter and you got to ask the right questions. If you ask these 10 questions in your scripting up front, you're going to know very, very quickly if this deal has legs or doesn't have legs. What's the address? Purchase price? What's the construction budget? What do they think the after repair value is? What do they think the as-is value is? What's their experience? What's their credit? What's their cash position? How much in liquidity do they have? How much are they willing to put into this project? Have they ever done projects like this before? Things like that. Obviously, you can go into a little bit more detail as well. But let's be honest, if the borrower doesn't have any capital, they don't have any cash, they can't do a deal unless obviously they get a credit partner, potential seller financing, cross-collateral other properties, things like that. You know, inside our lending business, we're doing 80% of purchase, 100% of construction. So the borrower needs at least 20% down plus closing costs, right? So 25, 30% they're gonna need into every single deal. If they don't have that, we can't do anything for them. Ask that question up front. Too many lenders take too much time. They're going out to properties, they're doing other things before they even know if the deal has legs. So make sure that you are asking the right questions up front before you proceed with anything else. And if you're not comfortable with it, continue to ask more questions, verify the information, things like that. Number 2, overestimating or not knowing property values. You need access to MLS. You can't go off Zillow. You can't go off comps and numbers off someone who does not have an economic interest in the property. Who doesn't have an economic interest in the property? The appraiser, the real estate agent, other real estate agents. You can use all of them for their opinions, right? It's important. You can access them for their opinions, but ultimately it's your capital on the line. You need to make the ultimate decision if it makes the most sense. You need to be verifying the data yourself. There's no better way to do that than jumping online and going to MLS. If you've been in this business for less than 5 years, I would recommend you stay in your local area that you know and go out to the properties, meet your borrowers, you know, learn the areas yourself. We did that for the first 5 years of the business. Not only do you do it for risk management, but it also helps you grow your business because this business is all about repeat borrowers, building relationships. Number 3, knowing how to qualify the borrower based on their character and how well they can execute. Collateral, most important, right? There's 4 C's: collateral, character, capacity, credit. In that order. Character is number 2. You need to make sure they are going to be able to execute and they're good humans, right? If they can't execute on this project, we're not in the loan to own game, right? But borrowers that are unsophisticated, that don't know what they're doing, that might not be good people, you could give them a $100,000 loan on a $1 million asset and they will figure out a way to default. I've seen it, it happens all the time. That default might not necessarily be a bad thing. That doesn't mean that you can't potentially have a default rate and collect and make money, but it'll be a headache. It's gonna default, and you gotta be careful about that. How do they communicate with you? Have they been telling you the truth? Do you Google them? Googling is very important. You can potentially do background checks, but you can also Google people and look up case searches and things like that. When you go and meet them in person, are they a good person? If you can't get them on the phone now when they want money from you, you will not get them on the phone later when you want money from them with monthly payments. Make sure they are a good character. That's very, very important in this space, and that you want to do business with them. You're tied to them through the life of the loan. Number 4, unrealistic exit strategies. Too many real estate investors think that a project is going to sell for significantly higher than it is. Most of the time, your comps should be less than their comps. That's just how it is, right? You gotta be conservative. You're the underwriter. You gotta wear an underwriting hat at all times. You gotta be conservative. You gotta protect your capital, even if you lose out on a deal. You gotta have a realistic exit strategy. Again, if someone has like not great credit and they might not be a good character and it's a big construction project, chances are they're not going to execute to the highest degree. And they're probably not going to sell it at top dollar. If I flip a property, you flip a property, somebody over here flips a property, we're all going to sell them for different prices based on our experience, what improvements we're going to do into the property, how well we know the property, who's going to sell the property for us, things like that. You know, how well we execute with construction. Everything's going to, there's a lot of variance that goes with that. So you got to be realistic of what they can do. Remember, if somebody's buying a property to fix it up and rent it out, there's no more after repair value. And after repair value is a maxed out property that is vacant, that is staged, that's ready to sell for top dollar to a new property owner. This day and age, there's a lot of buy and holds. Great strategy, great way to do loans, but you got to be conservative, more conservative on that. There's no after repair value on those. Those are nice, livable properties at that point. So you got like a shell, a crappy property, right? Then you got like a crappy livable property. Then you got a normal house, a nice livable house, and then a renovated, after repair value house, right? So you got to notch that down. Again, there's no magic formula for this. You just got to be creative and kind of use your brain of what you think makes sense. But let's say an after repair value is $225 for a fully nice, maxed out, renovated house. A nice livable house might only be $200. You got to base your numbers off that if that's the case. Soon as a tenant moves into a property, it goes down in value. It's not a fully renovated house anymore, right? Let's say the tenant destroys the house. It might have to be rehabbed again, right? Those are risks that you gotta take. Obviously, if you lend money to good borrowers that that can execute, or you feel confident they can execute, that alleviates a lot of that risk, but just, you got to keep that in mind. There's no maxed out after repair value as soon as a tenant moves in. Keep that in mind. Number 5, asking for unnecessary items. Make it easy for them to work with you and provide additional value besides just being a lender, right? So this necessarily isn't like underwriting risk management. This is more like you're not a commercial banker. If you don't need something, don't ask for it. It's just going to drive people crazy. I don't even ask for loan applications up front. Some lenders will say, "Oh, fill out this loan application. After you fill it out, I'll take a look and I'll talk to you." I get on the phone and I talk to borrowers immediately and keep it very, very quick. Ask those 10 questions, script it, get to the point, see if it's something or it can't. 9 out of 10 borrowers that we talk to, I can't really do anything, a good deal, or they don't have enough cash, or they won't accept my terms, or whatever the case is. So there's no need for them to do unnecessary work. Don't ask for tax returns unless you want the tax returns. If you need them because it's going to help you underwrite it, maybe it's a commercial transaction, then do it. Maybe you need to help, maybe you want to double check that they can qualify for a bank loan on the back end when they refinance, then ask for it. But if you don't need it, don't ask for it. Like, I don't care about a full bank statement with all the pages numbered perfectly with their name on every single one of them, like a bank might ask, or the last 3 bank statements. I don't care about that. I want an up-to-date current asset statement of where the borrower's cash to close is coming from. That's what's important to us. And if there's something in there that says, hey, I got money from somewhere else, like maybe a HELOC, or I refinanced another property, now I have liquidity to use it, that's fine. I ask the questions and I figure it out. But I make the transaction very easy to work with. We close quick, we're easy to deal with. Chances are you're gonna be charging more than other people. Chances are you're gonna have lower leverage than other people. So you gotta figure out a way to differentiate yourself from others and do good deals, but make life easy for them. Also try to provide other value for folks. Back in the day, we used to invite all clients in here and we did catered lunches for our office and multiple clients at a time. Those are things that we've done over the years. We've had swag that we give away to people. We've run meetup groups. We do free real estate trainings. Over time, we've done lots of things to provide more value. So it's like, hey, those are the guys from Hard Money Bankers. I like working with those guys, right? Figure out ways to differentiate yourself and provide value to them. Hey guys, if you like this type of video content, feel free to smash that like button. Feel free to subscribe. It would mean a lot. I'd love to do more videos of this. Also, if you're not aware, we run a Hard Money Mastermind group. We've been doing it since 2020. It's free to jump in, www.hardmoneymastermind.com. There are some additional advanced trainings and courses and groups and things like that are an upcharge, but for the most part, you can access the majority of the group for free. We didn't have any of these resources when we started in 2007, so it's our way to continue to grow the hard money and private money lending community, and I've made a lot of good friends and business partners that are other private lenders and other hard money lenders throughout the country. So it's been a good group, and I hope to see you in there next time.